You're watching Market Wrap, a weekly update on equity markets and outlook for next week with Mr. Pankaj Pandey, Head Research, ICICI Direct. Very good afternoon, Pankaj, and welcome to the show.
Hi, good afternoon, Geeta.
Pankaj, Friday being the last trading session of the year 2022, markets have stayed volatile during the year, but Indian markets have shown quite a bit of resilience, outperforming the global peers, but relatively not too much of returns this year. Sensex up 4.4%, Nifty up 4.3%.
Yeah, absolutely. I think when you sort of look at last few days, one, I think yes, the volatility has been higher. I think the other thing is that this volatility is coming on the back of lower volumes, especially in the cash segment. Volumes are down about 15, 20 odd percent than what you normally see. So I think largely it is our sense is that probably for next week also there could be some bit of a volatility which will continue to be there on lower volumes. But like you highlighted, we are sort of still being a lot more resilient than what you see for the rest of the market. I mean, when you look at post Japan's policy, we've seen markets correcting in the high single digits, whereas our markets is down about 2%. So that way we are still sort of doing a lot more better than what we have seen for a lot of other geographies. Now, domestically, when you see, we have seen a good bounce back in the mid caps and the small caps. So small cap is up about 5, 6 odd percent. So that way there has been some recouping of the losses what small caps have done, which is what we had seen a week before. So I think probably next week also on low volumes we may continue to see some kind of a volatility. But having said that, we still believe that probably markets will sort of bottom out somewhere about 18,000, 17,800 to 18,000 kind of a levels. And in
Okay.
January, we are still expecting markets to head higher to 19,200 kind of a levels. And largely, we have seen markets not really correcting for more than 3 weeks. So that way, I think this particular week we have seen Nifty gaining about 1 odd percent overall. I think, like I said, probably next week also we could witness similar volatility, but nothing changes materially in terms of market direction.
Mhm. Two important indicators that would really, give some direction to the markets will be the earnings, the quarter three earnings that will start in the first and second week of January, and then we have a budget on 1st of February. How do you see both of these key triggers auguring for the markets?
So I think when you sort of look at from the earnings perspective, probably for a sector like IT, you have a lot more furloughs. So probably this quarter is again expected to be soft. But I think what needs to be probably watched out more is on the margin recovery front because overall sense is that the attrition levels have sort of have been coming down, and if the deal inflows have been okay, so then probably I think the pricing damage in IT stocks have been largely done, but probably the price performance could still take some more time, depending on how the commentary pans out for most of your IT names. But in general, we expect that margin recovery for a number of sectors, be it auto, be it consumer durables, or a number of other sectors, because margins for a lot of these companies have been sort of beaten down because of the volatility in input prices. So from that perspective, there could be margin recovery across most of the sectors.
Mhm, mhm. Pankaj, if we talk about a U.S. Fed, where we have seen aggressive rate hikes in 2022, so what is expected? What does history suggest? How long does U.S. Fed really, keep this higher rate of interest going on?
So when we sort of look at last, say, 20 years or more than that data, every rate hike cycle, we've seen either the growth coming down or the US market entering into recession. And so from that perspective, we are expecting something similar to pan out because US GDP growth rate has already fallen from, say, 3.7% to about 2.9%, and the growth is expected to come down further to about 1%.
Mhm.
Historically, we have seen that the US Fed has not been able to keep interest rates higher for a longer period of time. I mean, we have seen aggressive rate hikes in the past also, but the Fed has not been able to maintain those aggressive hikes. So it has been there for a period of say few months, 2, 3 months, 2, 4 months. at best to say probably 12, 13 odd months. I think this current rate hike cycle where the interest rates have gone up beyond 5%, we have already seen 13 months into this rate hike cycle. So our
Mhm.
sense is that historically, US Fed has not been able to maintain this kind of a longish interest rate levels for a longer period of time. So our sense is that probably as and when the inflation gets softened. So we haven't seen a very big downfall or downtick in the inflation, but our sense is that overall it could be a matter of few more months where the US Fed will probably change its course.
Mhm. If that happens and the US Fed, changes its course and that there's a reversal happening, do you expect the export-oriented sectors like pharma, IT, chemicals to do better?
Absolutely. I think what we have seen is that when you look at IMF predictions for 2023, most of the economies they have downgraded even for India. While we are still sort of expected to grow at 6.1%, the growth rate numbers have been revised onwards. But history suggests largely that even in this global backdrop of weak growth, IT services or pharma have sort of done well. I mean,
Mhm.
case in point is when we sort of look at say, FY 2004 to 2010, I mean, Fed rates averaged about 3%. It made a high of 5.3% and low of 0.3%. And similarly, in the last FY 15 to say 20, again, rates were an average about 1% high of about 2.5%. IT exports have been very resilient. So, I mean, they have grown at 15% CAGR from 2004 to 2022. Similarly, pharma exports from 2004 to 2022 have grown at 10% CAGR. Even between periods when the rates have been higher, we have seen IT exports growing at say 22% and 9% during FY 2004 to 2010 and 15 to 20. So that way, I think overall, near-term volatility aside, structurally, these two sectors have always done relatively better. And our
Mhm.
sense is as and when the Fed changes its course, probably these sectors will witness better price performance. Overall, growth trajectory or historical template or historical facts suggest that there is no major downward shift in the overall growth profile for both these sectors.
The kind of resilience that we saw in the markets in 2022, and we can say that the domestic institutions have become as important for the market as the financial FIIs that we call them, because FIIs have been net sellers for 2022, while domestic institutions have really supported the market well. Do you expect this trend to continue? And do we really need FIIs now?
Well, we do need FIs, but I think what is also sort of clearly coming out is that the domestic investors are, or the retail investors are getting a lot more smarter than, and their behavior is that way has been very apt for the kind of scenarios what we have seen historically. I mean, we all know that FIs have sold to the extent of about 1.6 lakh crores as, from October 2021. Compared to that, the domestic inflows have been in excess of about 3.1 lakh crores. And whenever we have seen every major market fall, the domestic mutual fund investors, I mean, they've been putting a lot more money. I mean, when you look at even last few months where the markets had seen a decent amount of decline, the average inflows have been in excess of 15,000 odd crores. Now, when the markets have rallied, we are seeing the inflows have come down to say 4 to 4,500 odd crores. So that way, I think they're sort of buying more at lower levels and sort of selling when the market has sort of done a decent price performance. So this is a surprise data, but yes, I think from the investor behavior, it is looking like that domestic investors are getting a lot more smarter. They know the India growth story very well. So that way, I think it's a very interesting thing. But like I said, we still need liquidity. So besides domestic liquidity, which is provided by insurance companies, mutual funds, and EPFO money, we need FI flows also. So that sort of makes the market overall better, price discovery is better. But overall, I think the domestic investors are definitely gaining far more prominence and providing resilience, which is what we would expect to pan out in FY 23 as well,
Large caps
FY 24 as well.
Yeah, large cap have held smartly up, but small caps and the mid caps, selective performance we saw in 2022, but broader markets did not perform as well as your benchmarks or the large caps. Do you expect small cap and mid caps to outperform in 2023?
So our sense is that wealth creation could be far more bigger. We'll see in the small caps and mid caps than large caps, and there are a number of reasons for it. One is from the earnings perspective. If you look at, we've been saying that the Nifty EPS growth is expected to be about 15 odd percent, and we are
Mhm.
taking it from FY19. So because 2021 had been COVID impacted year, so FY19 was a sort of a normal year. So
Okay.
15% kind of a growth is expected for Nifty, whereas 26% kind of a growth is expected for mid caps, and 28.5% is the kind of a growth expected for small caps. So obviously,
Mhm.
small caps and mid caps are expected to deliver a better growth rate. Now, when
Mhm.
you look at from a market price performance perspective, typically the price performance happens in a block of say 2 to 4 years, and that is when we have seen Nifty say sort of doubling from the previous lows levels, and whereas the mid caps will deliver say somewhere about 2.3 times, and the small caps will deliver even more higher at about 2.6 times. Now,
Mhm.
if I look at from that particular block, so our sense is that what we have seen in the market is that the Nifty is up only about 1.7%, 1.7 times. Mid cap is about 1.8 times, and
Mhm.
small cap is up only 1.5 times. So if I have to sort of extrapolate from the historical performance,
Mhm.
there is a case for 50% kind of a price performance in the small caps, 30% in say case for mid caps, and
Mhm.
about 20% in the case of Nifty. So that way, I think our sense is that the mid caps and small caps will offer higher wealth creation compared to large caps over the next 2 to 3 years.
Where do you exactly find the pockets of value in the mid cap and small cap space, Pankaj?
So I think we'll be sort of discussing the New Year strategy. So there we are expecting to sort of, while there will be some large cap names, but I think most of our recommendations are going to be the mid and the small cap names. So I think
Okay.
one has to sort of wait for that. But like I said, we are sort of looking at more of domestic oriented themes because we are still not very sure how the global growth will pan out, especially in the first half, because we still don't know how much damage the interest rates hike are going to do to the growth. The
Yeah.
inflation trajectory is not very clear, and
Mhm.
which is why I think there are a number of unknowns. The COVID as a wave is also sort of panning out. We still don't know. Probably in a month's time, it will be clear whether it is going to have some impact or not.
True.
So volatility is going to be there, but overall, our sense is that it is better to be in domestic-oriented themes,
Mhm.
and where we haven't seen much of a price performance because we are seeing that sector rotation is sort of happening, and which is why we believe that wherever we haven't seen much of a price performance, be it infra, be it auto, be it number of other sectors, I think
Right.
those are the pockets where value is more.
Mhm. Talking about the auto sales number for the month of December, what is expected?
So when you sort of look at the wholesale dispatches, overall numbers are expected to be muted because
Mhm.
typically this is or last 2 months you see higher liquidation happening. Producers don't produce more, and which is why we expect that probably the CV space could witness month-on-month growth. Two-wheeler could witness a flattish kind of a growth, whereas the passenger vehicle could witness a bit of a month-on-month decline.
Mhm.
But I think within companies, we expect a good performance from M&M because overall their order book has been good.
Mhm.
Maruti, while the order book has been sort of very strong, the response to the new launches has been good, but they've been saying that they've been cutting production largely because of the chip supply issues. So
Mhm.
overall, we would expect softer set of numbers, which is expected to come out next week.
Mhm.
But I think these are sort of temporary issues because typically people don't or people refrain from buying older year models. So which is why I think it's just a temporary phenomenon for the month of November and December.
Mhm. Mhm. Rubber prices are on decline. So, do you expect this to impact the tire companies positively?
Absolutely. I think natural rubber prices, we have seen a good decline. I mean, in this last month itself, we have seen a decline of about 8 odd percent to about 136 rupees a kg.
Mhm.
Typically, for any tire manufacturer, natural rubber forms 50% by weightage and 40 to 45% by material cost. Now, if that is sort of coming down, obviously it will have a positive rub-off on most of your tire companies. I think last quarter was quite impacted for most of the tire companies. Now, what we
Mhm.
prefer in tire is that typically tier one players like say Apollo Tires, which had come up with one of the best margins. Here
Mhm.
our target price is 350. And Balkrishna Industries. So this is one company which is, although they've got exposure to Europe, but they are quite cost competitive compared to global players.
Mhm.
And our sense is that overall one should see margin recovery in this company going forward. Here our target price is 2200.
Mhm. Talking about Eicher Motors in the auto space, this stock has done well initially, but then we saw some bit of consolidation happening, profit booking at higher levels. Now the company has announced a strategic stake purchase, and it is going to purchase some stake in a European company. So, do you think this kind of a strategy where you will see acquisitions happening to really expand the markets augur well for companies like Eicher Motors?
So Eicher has been sort of benefiting from number of factors. One is their new launch, Hunter, has been sort of doing well. Then I think the concern in two-wheeler always has been that they are sort of not technologically that savvy, or they are sort of behind in terms of technology race. With this acquisition by Eicher, our sense is that they are looking to acquire niche capabilities, especially in the electric bike segment through this acquisition. And our sense is that it's a sort of a very good acquisition from that perspective. They already have a plan to sort of launch a EV bike post 2025. And
Mhm.
this company, which they have acquired, has got good set of numbers, has got a good set of bookings. So our sense is that Eicher overall is a premium play on the entire two-wheeler as a space. Along with that, they've got a CV portfolio. So that is
Okay.
also sort of expected to have positive rub-off. And on
Mhm.
top of it, if they are adding capabilities like this, because up till now the perspective was that they were looking to sort of do most of the capability building in-house, but now they are acquiring, so they are sort of turning aggressive. And I think that way, according to us, it's a sort of a positive. And within two-wheelers, I think this is the only stock which we prefer.
Mhm. One of the sectors that has shown a clear outperformance in this past week is the metal space. Because of the COVID easing of COVID restrictions in China, we have seen some bit of a buying interest in the metal space. But do you think that the move that we saw in metal counters is sustainable in the long run?
So I think a lot will depend on how COVID in China sort of pans out. But last week we have seen metals as a space sort of outperforming Nifty big time. So the index itself is up about 7, 8 odd percent.
Mhm.
And obviously, yes, when a big market like China is easing COVID-related restrictions, it is
Mhm.
having a positive rub-off on the overall metal as a space. We have seen metal prices inching up 10% in the last few days, and that has a sort of a positive rub-off because metal prices in China is now about $600 per ton. I think the
Mhm.
another positive is that the overall input prices have also sort of come down. So what we are also seeing is that the coking coal prices have come down by $40. That is another positive, and domestic demand has been pretty healthy at about 8 to 9 odd percent. So from that perspective, metals are in a sort of a sweet spot. But I
Mhm.
think the big catch always is that how the COVID behaves in China. If there is no major accidents we see, and overall this ease up remains intact, then we would want to believe that metal as a sector can do some bit of a catch up. Given the
Mhm.
fact that domestic demand is good and what you need is only decent pricing to sort of prevail globally, and which is where if China stabilizes, that can help. So, which is why I
Mhm.
think we like something like Hindalco with a target price of 500,
Okay.
NMDC with a target price of 130, and then Graphite with a target price of 440. And
Mhm.
then Midhani is another company which makes alloy for the defense sector. So that is another company which you like with a target price of 285.
Mhm. Pankaj, one sector which has shown outperformance in the last couple of weeks is sugar space, where we have a couple of news playing out. Is ethanol story is already there. Then we have export being allowed. The limit might be hiked. So that is what is playing out, and the output reduction is also news which is coming from the market. So overall, sugar space for 2023. Do you like it?
Well, yes, we've been liking this sector for quite some time, and I think a lot of structural changes are happening. So, at 10% blending, most of your sugar companies are deriving, say, 20 to 25% of their top line from ethanol. As that blending goes to, say, 20%, then obviously the volatility what you see in earnings for sugar companies is going to come down. We don't expect much of a change in the domestic prices, but I think globally they can benefit from higher prices, and which is where the element of positive surprise can come in. So from that perspective, I think sugar companies are sort of slated well for price performance.
Mhm.
And we are still in the sort of a crushing season. Probably 1 month down the line, we would know that if the recovery rate remains good, then probably the cost for them is going to be lower. So I think
Okay.
that could be another positive. But overall, with the kind of relative underperformance we have seen, I think this is an interesting space which can sort of outperform the markets from a 3 to 6 months perspective. Because I think 1 or 2 quarters down the line, we would expect companies to come up with a good set of numbers.
Pankaj, how will you play and strategize the first week of 2023?
Well, globally, you'll have some data release, especially whether you look at EU, whether you look at US or Japan. You'll have PMI data coming for both manufacturing and services. So obviously, that will have some implications. But like I've been highlighting, we have seen a lot more volatility in the markets on lower volumes. And I don't think probably that is going to sort of change even next week because next week also could be a similar kind of a setup where we could see volatility on lower volumes. And I don't think that one should be sort of taking that trend very seriously because that's happening on a lower volume. So, which is why we believe that somewhere down the line, 17,800 to 18,000 levels are going to be held. And as we sort of approach budget and earning season, the overall strength in the market will get picked up. And that is where we expect Nifty to head towards 19,200 kind of a levels.
Pankaj, thank you so much for your time
Thank you so much.
and wish you a very happy new year, a very happy and prosperous 2023.
Same here. I wish all the viewers a very happy and prosperous new year. Stay safe.
Thank you.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.